What's up, everyone? Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series for the month of December 2023, the last month of the year. In each episode, I pick 3 stocks that I think are trading on sale at today's prices for the long term. And to make things a little more fun and interesting, I specifically choose one lower risk, one medium risk, and one higher risk option for added variety. Please keep in mind though that in this series I am specifically looking for stocks that I think are on sale, which means that they are usually down a lot, and in this month's particular case, all 3 stocks have crashed by huge amounts. So there's going to be some risk tied to them inherently because of that you should be cautious of. So as always, please do your own extensive research and make your own decisions. But if you're still with me and you want to hear about 3 stocks that should probably be added to your watch list at the very least, then let's not waste any more time, because I actually really like these stocks that we're going to talk about today, and I can't wait to share them with you. So let's go ahead and jump straight into it. All right, and starting first here with the lowest risk option. You know what, this month I'm actually going to go with my first ever real estate investment trust, a REIT, in Extra Space Storage, ticker symbol EXR, which I just recently talked about as one of the biggest purchases that BlackRock made last quarter, and I actually decided to follow them into it this past week too, as I purchased the stock for the first time ever and I added it to my personal portfolio. Now that's a personal portfolio, not the public community one on Discord, but you know what, guys? I might actually consider adding it to that one too, because I do feel that they have a lot of long-term potential at these levels, as it has now crashed by almost half its entire value and isn't even trading that much higher today than it did throughout most of the past decade. Now, initially, the stock had soared by a lot in 2021, but since then, most REITs have really fallen by huge amounts as the economy deteriorated, and any pandemic-related tailwinds are now really turning into headwinds with those rising interest rates that are really high right now. However, I still think that EXR is better than most, as the need for storage facilities should always be there, really no matter what the economy looks like. Even if people are downsizing their homes or moving in with their parents, they'll probably need a storage space for putting away all of their items. Plus, it looks like remote work is here to stay, and all of those people working from home can use the extra space, pun intended, by renting a storage unit and decluttering their homes and workspaces. Heck, even if businesses are closing down offices, which is a very real concern for other REITs right now, well, that might actually benefit EXR, as many times they'll choose to store all of that office equipment in one of their units. In fact, storage units have always been a great choice for businesses because they can accept deliveries for them. They have larger warehouses and even climate control in many locations, and some even offer office space too, with amenities like Wi-Fi and such. Plus, another thing I like about the storage business is that it can generate revenue from multiple streams, including various fees and premiums for things like late payment or vehicle storage or business storage, or even all the packaging supplies and rental of moving trucks and all that kind of stuff too. Plus, they can also raise prices much faster and easier than other REITs because of the typical month-to-month structure that they use. I mean, this is the first REIT that I've added to my portfolio, and personally, I just think going with a storage-based one is a bit safer than most. Plus, it helps that EXR themselves are one of the largest in the space, which I think helps to further reduce that risk a little bit for me too, as they've already grown into the second largest in America, only behind Public Storage, with over 2.5 million units across more than 3,600 properties in 42 states, with also a very strong occupancy rate of a 94%. So the company is just by all accounts on fire right now, and you can see that in their financials too, that continue to break new record highs, which, thanks to another big acquisition recently of Life Storage, EXR is expected to grow sales by another 20 to 30% in each of the next 2 years. It's very strong. And while the valuation does seem to always trade for a premium to the sector because of that superior performance, the recent dip in stock price has at least lowered their PFO ratio significantly lower than both their 15 and 10-year averages by around 30% each. That's a pretty good discount if you ask me, especially for the dividend, which is really the best part of all that I haven't even mentioned yet, as it currently yields above 5%. Historically speaking, anytime it's yielded that much, it was a great buying opportunity, and I suspect this time will be the same for the long term. It's definitely not a stock for everyone, and even now I'm only buying it very slowly in small amounts because I do think that a recession would just hurt pretty much all REITs in general. But this one here in particular, I do feel is a bit lower risk than other options out there, and I think it's a great kind of overall choice here for me to be dipping my toes into a REIT. Moving on to stock number 2 though, increasing the risk a little more for our medium risk option, I'm going to go with a longtime favorite of mine that my brain just really can't comprehend how it's possible for it to crash by this much when the business is so incredibly successful, and that stock is the Chinese e-commerce giant Alibaba, ticker symbol BABA, who actually just recently reported earnings again too, and once again, I thought they were pretty strong. Not only growing sales by over 8%, but also operating income by over 30% and net income by over 200%. Mind you, this is already a gigantic market leader to begin with at about half the entire Chinese e-commerce market share, which, by the way, is essentially a triopoly with just JD.com and Pinduoduo, as really nobody else even comes close to them. And that's huge because the Chinese market is also the largest in the entire world at almost 3 times the size of America and is already worth over $3 trillion. Plus, speaking about America, Alibaba themselves are also bigger than even Amazon. And not just bigger, by the way, but also almost twice the size in terms of gross merchandise value. That's so crazy. I think if you ask the average person, they'd have zero clue about Alibaba actually having more e-commerce market share than Amazon. And yet, Amazon has a market cap that is almost 8 times the size of Alibaba, for good reason, of course. But it's still interesting to look at because they also have a much higher price to sales ratio, about 5 times as high of a price to earnings ratio, and close to 3 times the PEG ratio as well, which in the case of Alibaba is only less than 1, which is also considered a great value just on its own. And while their revenue growth did fall by a huge amount coming off of the pandemic, that was already way too high of a growth rate to begin with, as it was being fueled by mass lockdowns. So to recover now back up to around 10% growth going forward, I think that's more than healthy for a company this size. Yet despite all this, the stock actually continued to fall after reporting earnings, and is still down over 3/4 of its entire value from the top, leaving it at one of the lowest prices that we've seen in the past decade. Now, part of the drop after earnings has to do with their cloud business slowing down, which only grew sales in the quarter by about 2%, although adjusted profits did soar by 44%. But in my opinion, this is also more of just kind of a short-term issue with management and company structure than anything else, as the leader of the segment surprisingly stepped down recently and they canceled their planned spin-off as well. Once they get better organized though, I think cloud will remain one of the strongest parts of their business, whether it's in-house or spun off. There was also a lot of selling recently by founder Jack Ma though, but that's also been the case ever since he stepped down and really got checked by the Chinese government, which in my opinion is the real source of all of the risk in Alibaba stock. It's not the business itself, but rather the fact that it's a Chinese stock with a VIE structure, where if anything goes wrong, either being caused by the government or by the company itself, we as foreign investors would have very little rights in that situation and we could potentially get screwed. So that's one reason why I just generally consider all Chinese stocks to be quite speculative, just because of that fact alone. But if things end up going smoother in the future, especially with the relationship between China and the US, and also if the Chinese economy starts to show more improvement, then I think Alibaba stock could fly at these levels, and that's why I'm taking a chance on it. Now, by the way, I know that I compared it a lot to Amazon here in today's video. I actually think Amazon is a much better, much safer, larger, just kind of better overall investment, and I have, excuse me, I have a very large position in Amazon, whereas my position in Alibaba is relatively small in my portfolio. So you should be aware of that. But as a smaller, kind of riskier, perhaps more potential kind of Chinese version of Amazon, I think Alibaba is a pretty decent choice as well. Alright guys, now it's time now to finish up though with the third and final stock of the list, which is also our highest risk option. And this month, I'm going with General Motors, ticker symbol GM, who I know is not as exciting as Tesla, and most recently Warren Buffett actually completely sold out of his position, which spooked investors even further. but I'm here to make two general points about GM stock. The first point is that it doesn't need to dethrone Tesla in EVs, it just needs to grow that business out until they become a more respected competitor, which right now it's going to be hard to see them as one, as their sales have really been stagnant for years while Teslas have been on fire, and they continue to sell legacy ICE vehicles as the vast majority of their business, despite all of us knowing that the market is quickly shifting towards EVs and will likely reach an inflection point within this current decade, by most analyst calculations, which is also where all of the growth is that GM desperately needs. And to make matters worse, GM's own EV releases so far have either been too expensive for the average consumer or suffered from delays and supply shortages due to their lack of experience. That is also a direct result of Tesla just kind of going all in on EVs from the start, while these legacy players like GM really sat on their thumbs delaying the inevitable. But even with all of those negatives in mind, GM does still have a promising future with EVs if they can just execute on their plan. For example, GM probably holds the second largest autonomous driving business behind Tesla with GM Cruise, which, despite recent setbacks, it still holds some of the best technology in the world that they've been developing for many years, and has also been the first to market with robotaxi trials, which is something that even Tesla has been slow to launch or even attempt. And when it comes to EVs, GM actually has some very popular brands that will probably move the needle for them when their electric versions finally release or ramp up. Particularly, I think the Chevy Equinox will be a great alternative to Tesla SUVs, while the GMC Sierra and Chevy Silverado will also be great alternatives to something like the Tesla Cybertruck, which I actually really love the appearance of the Silverado, by the way, and I think it'll be a very popular choice for anyone that just wants like a traditional looking truck that is also electrified. I think it's super nice looking. I also think the Camaro will probably turn heads as well, although it'll probably be pretty expensive. But anyway, the point is that I don't think it's too crazy to assume that, some of these vehicles are going to sell pretty well, especially in the two main categories there of SUVs and trucks, where GM not only leads the entire US market at over 17% market share as a whole, like, all cars included, even ahead of other giants like Toyota, Ford, Honda, and also Tesla, which, by the way, ranks all the way down at number 9. But they've even beat these companies at their own specialties. Like, take Ford, for example. Did you know that the Ford F-150 has been the best-selling truck in America for over 4 decades? And yet, you know what's happened over the past 9 years? GM has actually outsold Ford trucks as a whole in every single one of those 9 years straight. How crazy is that? They even did over 100,000 more light and heavy duty trucks last year too. And when it comes to SUVs, which by the way is the most popular category when you include crossovers, well, no one even comes close to GM. They've been ranked number 1 for almost 5 decades in a row. And it doesn't even stop there, as GM also has another commercial product in BrightDrop, which is an electric van that specializes in deliveries, especially for other businesses, which has already received some pretty large orders. There's one from Ryder that is supposed to be like 4,000 by 2025. And the business is already set to do about $1 billion in revenue per year. And GM estimates that it could generate as much as $10 billion with 20% profit margins by 2030, which would be huge. Overall, I think there's a lot to like here, and especially for such a cheap valuation, which is actually my second point that, at this price, for me, I just think it's worth taking a shot on at this low of a price here, after the stock has now crashed by over half its entire value to now one of the lowest prices in over a decade, leaving their PE ratio over 50% cheaper than their own 5-year average and over 70% cheaper than the sector median as well. Like I've said before, I still hold much stronger belief in Tesla stock, which I am also very heavily invested in, whereas GM is just a very small kind of newer position that I'm actually down on, by the way. So I actually have to buy more GM stock right now to lower my cost basis on it. But I still feel that the overall EV market in the future will be large enough to support multiple players. And I do feel that GM could be one of the successful ones in that space, but we'll have to wait and see. But anyway, those are just my thoughts What do you all think about these 3 stocks? Do you like any of them? Are you investing in any of them? And what other stocks are you guys buying right now? Let me know down in the comments so I can make future videos about those stocks later on too. But anyway, thanks again for stopping by, my friends. I hope you enjoyed the video. Thank you for all the support. Please hit that like button, subscribe. Really helps keep my channel alive, and it means a lot to me. But thanks again, everyone. I hope you're all doing well, and I will catch you in the next video. Take care, everybody. Bye-bye.